This isn't a soft currency story unfolding over months. This is a 2-day stress test where the price is lying and the spread is telling the truth, and the institutions that swear everything is stable are about to learn the difference between reserves on a balance sheet and dollars that can actually clear demand before the deadline hits. Because here, S what S happening in plain language, the official rate can sit there like a statue, perfectly calm, while the real market starts paying up for speed. Not for ideology, not for vibes, for speed. And when that premium widens in 48 hours, you're not watching a debate. You're watching plumbing seize up. And the payoff in this video is simple. By the end, you're going to have a checklist you can run next week without guessing. What level matters, what confirms the pressure is real, what would cool it off, and what breaks if the next round of demand shows up and the supply side doesn't. Now, if you only look at the headline rate, you're going to miss it. You'll get lulled. You'll think nothing happened. But the people who actually need dollars, importers, brokers, anyone trying to move inventory across borders, aren't trading headlines. They're trading settlement. They're trading paperwork. They're trading time. And that's where the real pressure starts. Let's start with the street symptom because it's always the first tell. Over the past couple weeks, and especially in bursts of a few days, we've seen the parallel market price in at least one major dinar system jump hard. Think the kind of move where on the street, $100 costs something like $138,000 dinars, and then suddenly it S closer to $148,000 or more in short order, while the official anchor is still sitting around $1,300 per dollar. That sounds like a small difference if you're not used to it. It is not small. It's a premium for immediacy, and it's a premium that tells you the market is paying extra because the normal channels aren't a T clearing. And notice the shape of that move. It doesn't drift, it gaps, it lurches. That's not fundamentals slowly deteriorating. That's a liquidity event, but that's not the part that matters. The part that matters is why the premium shows up now, why it shows up fast, and why everyone who keeps repeating reserves are high is accidentally making the problem worse by encouraging the exact behavior that forces demand into the parallel market. Because in these economies, dollar demand isn't a mood, it's a calendar. Here's the mechanism, and I'm going to keep it clean. In a controlled FX system, the official rate is an administered price. It's a policy tool. It's the rate the state wants you to see, the rate used for budgets, the rate used for certain approved transactions. But the parallel market is a clearing price for urgency. It's the price you pay when you can't wait for approvals, when you can't risk a delay, or when the system suddenly changes and your old workflow stops working. So when someone says the dinar is under pressure, what they really mean, if they're being honest, is the time to dollar just got longer and people are paying a premium to compress it. That's the hidden detail, and it changes everything. Reserves can look strong while the market behaves like they're gone, because the bottleneck isn't the existence of dollars. It's access to dollars on time. And once you understand that, the last 48 hours stop being mysterious. They become predictable. Think about how dollars are actually demanded in a dinar economy. You've got importers who need to pay suppliers. You've got customs processes that require proof of payment or prepayment. You've got banks that have to clear compliance checks. You've got official platforms, documentation, and settlement windows that don't care about your feelings. If you miss a window, you don't just wait. You lose inventory, you pay penalties, you lose relationships. You get pushed out by someone else who found dollars faster. So what happens when a new rule hits, or a new custom system tightens timing, or paperwork requirements change? Demand doesn't disappear, it front runs. Everyone who needs dollars tries to get them earlier. Everyone who can't get them officially goes cash, and cash is where the premium lives, because cash is the physical market of FX. It's not a derivative, it's not a promise, it's not we'll settle later. It's physical versus paper, but in currency form. Bank cleared flows versus street cleared flows. And when the bank channels slow down, physical wins on speed at a higher price. And that's where the math flips. Now let's layer in the why now, because this is the part that gives you the timeline. You're not dealing with a random shock. You're dealing with calendar pressure, early year resets, policy implementation windows, month-end effects, salary cycles, weekend gaps that thin liquidity, and in at least one major case. There has been heavy talk and reporting around new customs clearance procedures and systems, like Asacuda-style digitized clearance processes, pushing traders toward the parallel market because the system changes the timing of when dollars are demanded and how quickly they must be shown. That sounds boring. It isn't. Because if you move the payment requirement forward, if you force pre-customs payment mechanisms or tighten the verification chain, you compress the time importers have to source dollars. That turns normal demand into urgent demand. Urgent demand doesn't politely queue at the official window. It hits the parallel market like a wave. And you can see it in the behavior. Instead of a smooth drift, You get a jump in the street price over a handful of days. You get dealers widening quotes. You get panic language. You get a premium that suddenly becomes the headline. But the premium is not the story. The premium is the symptom. Here's the reflexive piece that most people never talk about, and it's crucial if you care about what happens next week. Dealers, currency shops, middlemen, brokers often run short dollar inventory, not because they're evil, because it's efficient. Holding a big stack of dollars is expensive in opportunity cost and risk. They rely on turnover. They rely on the ability to source dollars when needed. It's basically inventory management. So when demand spikes and supply slows, dealers go short, they sell dollars they expect to replace, and then the replacement fails, and then they have to cover at a worse price. That's short covering mechanics, but in the cash FX world. And when short covering hits a thin market, it doesn't just push price, it accelerates it. Because every dealer covering is another buyer, and every buyer tells the next dealer, don't sell cheap, you might not be able to replace it. That is how you get a two-day pressure event without a single reserve dollar vanishing. It's a timing mismatch plus a positioning squeeze. And if you're waiting for the mainstream to explain it like that, you're going to be waiting a long time. Now, let's talk reserves, because this is where people get emotionally manipulated. You'll hear, foreign reserves are high. In Iraq's case, for example, you all see figures floating around the high tens of billions. Numbers like roughly $90+ billion of reserves in late 2025 being discussed publicly. And yes, those are big numbers. They matter. They're a shield. But reserves are not a magic spell. Reserves don't automatically become street liquidity on demand, instantly, at full force, without friction. What trades is the market's belief that those reserves can be mobilized fast enough, through channels that can clear compliance, to meet demand in the window that matters. So if you're sitting on a pile of water behind a dam, and the town is thirsty, the town doesn't care how much water is behind the dam if the gate is stuck. The town pays for bottled water. That's the parallel market. And that's why this story is reserves versus demand in 48 hours. Not reserves versus demand in theory. Reserves versus demand in the only time frame that hurts, right now. Now stack your proof, because one argument is never enough. Proof point 1 is spread behavior. The official rate stays pinned, budget ready, policy stable, while the parallel rate jumps and the gap widens. That tells you it's not a repricing of the official anchor, it's a repricing of access. Proof point 2 is policy and system timing. When customs procedures shift, when digitized clearance or prepayment requirements change, when the system suddenly asks for new documentation or new sequencing, the demand curve doesn't get smaller, it gets earlier. That is literally how you manufacture short-term pressure without changing long-term fundamentals. Proof point 3 is institutional throughput. If banks and official channels are constrained by compliance checks, by capacity, by policy friction, then dollars might exist, but they can't pass through the pipe fast enough. That pushes demand into cash, and cash pricing is almost always uglier than the headline. Proof point 4 is the on-the-ground behavior around salary cycles and delays. When people expect local currency liquidity events, like government salary payments or delayed disbursements, it can change how quickly they try to convert. It can change speculative behavior. It can shift market psychology from wait to front run, which itself becomes fuel. Proof point 5 is cross-market comparison. Look across the region and you can see similar signatures. Libya's dinar, for example, has seen episodes where the parallel market rate weakens sharply. Reports recently described the dollar trading above 9 dinars in major cities on the parallel market at a moment of political and institutional tension. Different country, different structure, same stress fingerprint, parallel premium widening when access and trust are under strain. That's not coincidence. That's how controlled FX systems behave under timing pressure. And here's proof point 6, the quiet one. Official commitment language tends to show up right when the spread starts screaming. When central banks or finance ministries reiterate the official rate for budget purposes, like confirming an official anchor around $300 per dollar for a new budget year, it's a signal. They're telling you, we are not moving the statue, but the market is telling you, fine, then we'll price the urgency somewhere else. Now, does that mean collapse? No. And if you jump straight to collapse narratives, you're playing into the emotional manipulation part of this market, because the volatility itself is the weapon. Here's how it gets used against you. The price spikes, everyone panics. Then it snaps back a bit, and everyone relaxes. Then it spikes again, but this time the headlines say crisis. And the emotional crowd either FOMOs into dollars at the worst price, or they swear off the trade entirely right before the next leg. The market doesn't need to conspire to do this. It's a natural consequence of thin liquidity, information asymmetry, and the fact that most participants don't understand the mechanism. So your job is not to predict the headline. Your job is to separate trend signal from noise. Trend signal in this context is the persistence of the premium and the behavior of the spread over multiple sessions. Noise is the intraday whip, where one big flow hits a thin market and prints a scary number. And that's why the next detail is what flips the whole setup. Because in the next week or two, this story becomes less about what happened and more about what is forced now. In market terms, pressure forces behavior. If the premium stays wide, authorities face a choice: increase official dollar supply throughput, adjust procedures, crack down on leakage, or accept that the parallel market becomes the real price discovery venue for a while. Meanwhile, importers face a choice: pay up for speed, delay shipments, or reduce volume. Dealers face a choice: widen spreads, hoard dollars, or risk getting squeezed again. Those forced choices are what move price, not the hot takes. So let's talk about what comes next in a way that's actually usable. You're going to see two scenarios. Don't marry either. Track them. Scenario 1 is a controlled pullback and retest. This is where the official system increases throughput. More dollars clear, delays ease, fear cools, and the parallel market rate softens. But here's the key. It doesn't go back to normal instantly. It retests. It checks whether the demand wave was temporary or structural. In that scenario, the premium compresses, volatility fades, and the market tries to re-anchor around a tighter spread. Scenario 2 is continuation pressure, a squeeze with gap risk. This is where the next demand window hits. Another custom cycle, another batch of import payments, another settlement deadline, and the official channels still can't clear fast enough. Dealers remain defensive. They stop selling dollars aggressively because they don't trust replacement. The market becomes one way for a time. In that scenario, you get air pockets. You get sudden prints. You get the kind of price action that makes people say, "I'm manipulation," when it is really just thin liquidity plus forced buying. And if scenario 2 plays out, the math changes. Now, you asked for levels, not poetry, so let S frame levels in the only way that matters in this market. Psychological bands around the parallel rate and the spread itself is the core indicator. In an Iraqi-type setup, for example, if the official anchor is around 1,300 per dollar, then every time the street price pushes meaningfully beyond the mid-140s per $100, you're watching stress. If it holds there and keeps pushing, you're in scenario 2 territory. If it fades back toward the low 140s and the premium compresses for more than a day or two, you're likely in scenario 1. But don't obsess over the exact number. Obsess over the behavior. Does the market snap back quickly after spikes, or does it grind higher? Do dealers tighten quotes again, or do they keep spreads wide? Does volume migrate back to official channels, or does the parallel market become the default? Those are the tells. And here's the confirmation set that matters next week. Confirmation that pressure is real and persistent looks like a premium that remains wide for multiple sessions, repeated spikes around known calendar windows, and continued reporting of friction in customs or banking throughput. It looks like officials reiterating stability while the street keeps paying up. It looks like dealers acting like they're short supply, because they are. Confirmation that pressure is easing looks like narrowing spread, calmer street quotes, fewer gap-like moves, and evidence that official mechanisms are clearing trade payments more smoothly. It looks like the urgency premium collapsing. Now, what invalidates the whole 48-hour pressure thesis? Simple. If throughput improves and demand wave passes, the premium should compress. If the premium doesn't compress even when official supply increases, then you're not just dealing with timing. You may be dealing with deeper confidence issues or structural leakage, smuggling, misinvoicing, capital flight pressures that keep the parallel market bid. That's the line in the sand between temporary squeeze and regime problem. But don't jump there first. In these markets, the most common story is the boring one. Timing mismatch plus friction plus reflexivity. And that's exactly why it is so tradable in terms of understanding, even if you're not trading the dinar itself. Because this is a macro signal. It tells you about dollar scarcity, about how policy interacts with real commerce, and about where pressure is building in the broader system. Here's the commodity crowd connection, because it matters. These dinar systems are often tied to oil revenues and dollar inflows. When oil flows are steady, reserves can build. But even then, if the mechanism for converting those inflows into domestic dollar liquidity is bottlenecked, the street can still experience scarcity. The oil billions but no currency stability paradox I'll hear people complain about. And the resolution is always the same. Reserves are not the same thing as distribution. This also connects to global dollar strength. When the dollar is bid globally, higher US yields, tighter global liquidity, stronger risk-off tone, it makes every controlled FX system more fragile at the margin. Because the opportunity cost of holding local currency increases, and the demand for dollars as a store of value intensifies. That doesn't mean the dinar collapses. It means the premium becomes more sensitive. The spring gets tighter. And if you're a metals person, you should recognize the pattern immediately. It's paper price versus physical premium, but translated into FX. The official rate is the paper price. The street premium is the physical premium. And when the physical premium widens, it's telling you the same thing. Delivery and access matter more than theory. So what do you watch? Specifically, over the next week or two? Not opinion, not slogans. Plumbing, watch the spread first. The spread is your dashboard light. Watch policy execution next. Custom systems, prepayment rules, changes in clearance procedures. Anything that changes the timing of dollar demand will show up in the parallel market before it shows up in official statements. Watch bank throughput and compliance chatter. If banks are slower, the premium rises. If banks are faster, the premium falls. It's that simple. Watch cash market behavior. Are dealers hoarding? Are quotes widening? Is the market one way? Those are positioning tells. Watch for intervention signals, not the rumor, the effect. Does the premium compress after official action, or does it shrug it off? And watch the calendar like a hawk. Weekend gaps, month end, early month settlements, any known implementation deadlines, because thin liquidity plus deadline demand is how you get the sharpest moves. Now, I need to say this clearly because the credibility piece that keeps you from getting wrecked emotionally, price can whip around violently even if the thesis is correct. In fact, if the thesis is correct, if liquidity is stressed, the whipsaws get worse. That's not a contradiction. That's the signature. So if you're the kind of person who sees a spike and immediately makes a life decision, this market will eat you. It will spike, you'll panic, then it will snap back just enough to make you feel stupid, then it will spike again. That's not personal. That's structure. Your shield is a simple rule. Do not treat one print as a trend. Treat repeated behavior across sessions as the trend signal, and treat single session drama as noise until it proves otherwise. And here's the part nobody wants to hear. The market will try to make you pick the wrong time frame. It will zoom you into the most emotional 15 minutes. It will drag you away from the mechanism. It will flood you with, this is the end language. Your edge is refusing to play that game. Because if this is truly reserves versus demand in a 48-hour window, then the outcome is determined by one thing. Can the system deliver dollars at the speed the real economy needs without forcing everyone into cash? If yes, the premium compresses. Scenario 1. If no, the premium persists, and the next demand wave turns into forced buying again. Scenario 2, and that's the entire movie. Now, if you want one quiet metric to treat like a heartbeat monitor, it's not the official rate. It's not the speech. It's the gap, the spread, the premium. Whatever your region calls it, that number is the truth serum. And if you're still tempted to reduce this to good guys versus bad guys, don't. Incentives are enough. Controlled systems create bottlenecks. Bottlenecks create premiums. Premiums attract speculation. Speculation accelerates the move. Then authorities respond, then the market tests the response. That loop repeats until the timing mismatch is fixed or the regime changes. So here's your practical ending, no begging, just an identity check. If you're a macro watcher who likes mechanisms, who doesn't need a hero or a villain, who just wants to see the pipes and run the checklist, you're already ahead of most of the market. Stay with people who measure the spread and the calendar, not the vibe. Next week, watch the premium, watch the throughput, and watch what happens at the next deadline window, because if it doesn't cool off when it is supposed to, that's when the pressure becomes something bigger.